Before I start, I'd like to say a quick thank you to our sponsor, Fidelity International. You can find out more about them at fidelity.co.uk/money to the masses. Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's going on in investment markets and what to look out for in the days and weeks ahead. Now, you will notice that the setup is very different. It's probably, the sound's not quite as good as usual, and you'll see if you're watching the video version of this that I am actually at home. Like everybody else, we're having to make do with the coronavirus shutdown, so it doesn't impact the quality of what we do, but it just means the sound and audio sound slightly differently, and you may get a gate crashing from my children who are off school. But where are we with investment markets? Now, it's been one hell of a week, because if you remember last week, I spoke a lot about the market had fallen and things could get worse. And in fact, they did. I mean, we're in a bear market and the S&P 500 fell down to 2,237. So we were starting to push below or towards those lows back in 2018 that we achieved on Christmas Eve. And there was a real threat that we could push further down towards, say, 2,000 on the S&P 500. The FTSE fell down to 4993. These are closing prices. I always talk about closing prices rather than the intraday ones, because closing prices matter more than the intraday ones, because intraday there's a lot of volatility, as you know. The DAX had fallen down to 8441, and we saw the 10-year US Treasury yield become increasingly volatile and actually rallied up to about 1.2 and then has pulled back down to 0.8 as we speak. But what we've also seen is the continuation of all this monetary policy and fiscal stimulus from around the world. So we had the Fed go all in, literally all in, when it came to monetary stimulus. So they ended up expanding their QE, or their quantitative easing program, but with no upper limit to the amount that they would buy in the US Treasury market, and actually were extending it further out into corporate bonds. So basically it was QE unlimited. This is mind-boggling. If you think about it, when we go back to the financial crisis, we were nowhere near this kind of monetary stimulus. And then if you throw on top of that the fiscal stimulus that we're getting around the world, for example, the $2 trillion package that's been announced in the US includes checks that could be going to members of the population, the US citizens, valued at $1,200. I mean, this shows the extent of the issues that the coronavirus is going to cause for the global economy. But having said all that, we then had a bit of a bounce at the beginning of this week. And I know a lot of you will be sitting there looking at your portfolios and you'll be sitting there thinking your portfolio's 20+% down, even though it's very diversified. As I explained last week, everything's becoming very correlated at the moment. So assets like gold, bonds and equities are all moving in the same direction at the same time. And we want to see that break down a bit. We want it to go back to how it was, but that will be when the stress levels reduce. To make you feel better, Warren Buffett, who is the greatest investor of all time, that's pretty much what people acknowledge him to be, and he's a value investor. Year to date, his portfolio is down about 34-35%. So it shows you this is widespread. It doesn't matter who you are. This sell-off is unforgiving. Unless you're in cash, then you will be sitting on paper losses. Now, we had a rally, as I mentioned at the beginning of the week. Funnily enough, after the stimulus package from the Fed was announced, the market tumbled, and then it got a footing, and then we had some incredible rallies. I mean, to give you an example, the FTSE 100 rallied more than 9% in a single day this week. That was the second best day ever for the FTSE 100 to make gains. And interestingly, we saw similar bounces around the globe on equity markets. I mean, in the US, they were up above 10%. But we need to give this some context, because the other five, if you take the FTSE 100, for example, there were the other 5 best ever days for the FTSE 100 they all tend to be in 2008 and around November 2008. Just out of interest, the one date where the FTSE 100 did better than we saw this week was, in fact, I think it was the 24th of November 2008. So it's back in that financial crisis period. But in bear markets, which is what we're in, you get bear market rallies. It doesn't mean we've hit the bottom and we're destined for a V-shaped recovery. If you look at history suggests that we tend to get retests of lows and we tend to get rallies, bear market rallies, and bear market rallies are some of the strongest rallies you will see. They happened in the financial crisis, and as by way of example, after all those best ever days in 2008, the FTSE 100 eventually tumbled even further and fell a further 13% into the lows of March 2009 when the market eventually hit its bottom. So the bear market rally could be called a dead cat bounce, a suckers rally. People flood back in. People who were short in the market start to cover those shorts, so they start to buy back into the market to limit their losses, and it pushes the market up higher. People who think the market has found a floor start to panic and they buy back in. But then eventually the economic fundamentals, gravity starts to take over. And what is interesting is that today we've just seen the biggest ever increase in the weekly unemployment numbers in the US. I mean, it's over 3 million people have been added to the first claims for unemployment. That's incredible. I mean, and the market, as I look at it now, is rallying today. It suggests that we perhaps are going to see a bear market rally. It'd be very unusual if we didn't, and we will probably, more than likely, it's not a prediction or a promise, but the lessons of history show that we will inevitably sell off again. So it's just to give people a pathway, an understanding of how markets work. We're not out of the woods just yet. One of the key giveaways of that is the VIX. So the VIX, the fear index on US stock markets, that is still up above 60. If we want to see a bottom in markets, we need to see the VIX come back down towards historic levels, which is, like I said last week, the average is around about 20. But that 20 level has even more importance. In the past, when the VIX has fallen below its own 200-day moving average, which at the moment is hovering near 20, that's been a sign for the all clear for equity markets. So we are a long way from that. The volatility in treasuries and gold is still high. It's tried to pull back, but it's seemingly increasing again. We've still got wide spreads on corporate bonds. So basically, the bond market is still showing signs of weakness. But having said that, the central bank action that we saw in the last week has steadied the ship. And if we see bond markets start to steady, then, as my analogy last week about the skyscrapers wobbling, if the foundations start to steady, then we're more than likely going to see at some point in the not too distant future a bottom for the market. And as I say, there's signs that the bond market is trying to steady itself. One way to look at it, if you Google LQD, it gives you the investment grade bonds. It's an ETF that shows you investment grade bonds, that how that market's doing. It's a very good quasi indicator, and that just shows you, pretty much gives you a global idea, particularly in America, how investment grade corporate bonds are doing. And if that is steadying, if we're seeing that tumble like we did in the last couple of weeks, then that means that it's falling alongside equity markets. We want to see that start to show some signs of moving in the opposite direction to equity markets, or basically not in the same direction, i.e. uncorrelated. So if we see some strength there, that could be a sign that the markets could bottom. But don't forget, equity markets don't bottom when the economy does. They always work as a discount mechanism, and they always look 3 to 6 months ahead of the economic realities at that point. So you will start to see the equity markets pick up before the worst of the economic bad news is out there. And on that, we're only just starting to get some of the economic bad news, which lends even more weight to the idea that perhaps what we're seeing is a bear market rally. Now, the other thing that we'd want to see in investment markets is an improvement in breadth. So we want to see fewer stocks in all the various different indices around the globe. We want to see fewer of those making new lows. We want to start to see the market pick up and there be an improvement. Tentative signs of that, but it's way too early. So at the moment, with the VIX so high, we are still likely to see 5% swings almost on a daily occurrence in equity markets. And we're going to see that volatility in bond markets as well. Now, to show you how extreme this is, this period is very soon going to be the most volatile period for equity markets since the Great Depression almost 100 years ago. That means there's almost nobody alive who has invested through in their adult life a period that is as bad as this. So if you're surviving this period, it's a great lesson for everybody, but things will get better. Patience and time are the things that we have as long-term investors. But let's finish on a piece of good news. Now, for 80/20 investor members, I will be talking more about breadth in the newsletter this week, but I also talked about, just updated a piece of research I did called the Perfect ISA portfolio. Now, this portfolio is a portfolio where the aim was that the portfolio made money in every tax year since ISAs came to in existence, which is the year 2000. And I also wanted that portfolio, when I created this portfolio 5 years ago, I researched what was the perfect asset allocation that doesn't change, where it would get that's had a positive return every tax year and has also beaten the FTSE over the entire period. If you'd invested and kept investing in your ISA allowance, how was there a portfolio that did this? The answer was there was. And so going forward every year, I've been going back and reviewing how that portfolio does. And incredibly, we're at the point, even this year, that portfolio is likely to make a positive return for the 20th tax year in a row. And the asset allocation hasn't changed, as I mentioned, but also it has now more than doubled. It's achieved more than twice the return that the FTSE 100 has over that 20-year period. If you want to know more, you can take out a trial of 80/20 Investor where I talk about the portfolio. And in fact, there's a fund out there that almost by coincidence has the right asset allocation that I identify in the research piece that people can invest in. Now, that is it for this week on Damien's Midweek Markets. As ever, you can email me at damien@moneytothemasses.com, Twitter, moneytothemasses with the number 2, and Instagram. And do join our Facebook group because there's a lot of really good content that's in there where people are sharing their experiences through this crisis and this period of uncertainty. And a lot of people will find it incredibly useful. And also do subscribe to our YouTube channel.